or something like that.
So,
let's say it's I don't know, 7,000.
7,000. Okay. So 7,000 plus 7,200, that's 14,200, and then another 5,000, that's 19,200. So would that 19,200 pretty much be taken now and put against their
Rental
income?
Yeah.
Yeah. Now, if you so basically, guys, if you generate, let's say you make $20,000, right, that year on your rental income, you only you're only liable now for $1,000 of that income versus being liable on the 20,000 that you made.
Correct.
Because these things added up and basically brought your liability down. You guys see the power of that?
Yeah, so don't get caught up on the 7,000 alone.
Yeah.
Get caught up on everything else. That adds to the total.
Yeah. Can we put like the taxes in there, 5,000 and everything?
Well, I just wanted.
Oh, okay.
I want to make the point because those are going to be the constants. This is the variable.
I see what you're saying. Okay.
This is the variable.
Okay. I see what you're saying.
It's going to be real estate taxes on both columns, right?
Okay.
But this is
Perfect.
This is the game changer here.
Okay.
So I think we focus on this. So if you do a cost segregation study, right?
Okay. So now we're going to do the more the cost segregation part of this, guys, which is another more accelerated version of depreciation here.
Same thing, same price, right? Same land cost allocation, 20 grand for the land. Okay. But then instead of taking just the 200,000 and lumping it in 27.5-year property, we're going to take and segregate that into 50,000. Show you 50,000. This is a very simple like let's say my cost segregation study that I came up with came out to this.
Okay.
I said, okay, I allocated like 50,000. It's not necessarily always going to be this way, but I'm just going to drive the point home. Okay. So that's 200,000. So here, let's say it's like appliances or something. Obviously that's high. Or let's say roof.
Yeah. It's basically anything that is non-structural, guys, is the big takeaway here.
Okay.
Let's
say this
paint.
Is, let's say this is electrical,
Mhm.
okay, which will be all the electrical components of the house. Okay. And
Floors,
let's
maybe.
Let's say this is let's see what did I have on these here?
AC windows.
Let's say let's say windows or something like that. Okay.
Windows are expensive, man. God damn.
And now this I'm just going to call it improvements, okay?
Especially hurricane impact windows.
Yeah. Okay.
So now let's say we did here 15 for the roof. Okay. Let's say we did 10, 5, and then here 0. And then we'll get to that one, okay? Because we could take bonus on here, okay? So if we use these numbers here, now we've got depreciation of.
Here, can you just talk to Mike, Steve, so they can hear you?
Sorry about that. Yep. So we got depreciation of for the roof at 15. I think I did this wrong here. You gotta help me out with my eyes here.
Okay. So we got the first
50.
Wait, hold on. 50,000?
Yeah, I got it here. All right. So let's say I think 15. 50 to 15, right?
What's your total?
Yeah. So we got 3 for there. What was the other one?
We're just lining up the numbers for you guys real quick so you can see kind of like how this this works.
And this will be 10.
Give you examples of like, but essentially what it is it's
5, sorry.
it's essentially non-structural fixes to the house, guys.
10. Okay.
Back to
And
high
this will
school.
be 0 because we're going to take this as bonus. Okay. So in this case, we got 65, 68, 333
And then
in
the bonus.
depreciation expense. Versus if we didn't do the costs, only 7,000.
Okay.
So it's about a $61,000.
Okay, so let's walk them through that
difference.
so that they completely understand.
Recap. Yeah.
Yeah, let's recap that real fast. So now, we showed you guys how basic depreciation works. Now we're going to talk about how the cost segregation version, which like I told y'all before is the Super Saiyan Blue version of depreciation, how that works so that you can more aggressively, deduct and cut your liability down. So can you walk them through the numbers real quick with the cost seg on there, Steve? Please?
Okay, so basically, I took this roof at 15 years. Electrical, let's say components was 50,000 at 10 years. Let's say windows and so forth are 5-year assets, and that's $50,000. And then improvements, we can write them off because it's bonus. It falls under the bonus depreciation, meaning kind of like your car section 179. You can deduct it all in 1 year.
In 1 year, you can
Okay.
get it up front essentially,
So
right?
this one will say it's all 1 year. Bonus.
Okay.
This is the bonus, right?
Cool.
Let me put bonus in there so everybody knows. I don't want to put.
So you guys see the difference here where now he's depreciating it over a shorter period of time versus 27.5 years. Now he can depreciate it over 10, 15, and he was giving you different, he's using different types of fixes so that you guys can see the numbers with 15-year depreciation versus 10-year versus 5-year, etc. So you guys have different examples and a bonus one as well. So
Correct.
it's multivariate there.
So I just did the math here, I lined them here and total up my total depreciation deduction under my cost segregation. And you can see 68,000 plus versus just over 7,000. It's a $61,000 difference.
Yeah.
And
then
you could take that and it's
huge.
now,
Good.
so let's say this produced a loss
Okay.
now, and you're not a let's say you're not a real estate professional. You
Oh,
can
and
take
we're
up-
going to break that down for you guys too.
Yeah.
Being a real estate professional, being not one, how this will help you. Sorry, go ahead.
So if you're not a real estate professional, you could take up a $25,000 loss.
Okay.
But if you are, then you could take the full loss. So in this case, let's say you're at a 25% tax bracket, just for simple math.
Mhm.
The difference in that is going to be tax savings of $15,250. That's huge.
And someone that's in a 25% tax bracket, roughly how much are they earning per year?
25% would be like, I think I want to say like in 150,000.
Okay, so that's substantial
Yeah.
for someone that is earning about 150,000 per year. So that cuts if you earn 150K per year, guys, gross, now they can only tax you on 135,000 gross, roughly.
Yeah.
Versus that full 150. So now you're not not liable for as much, right? So and then we got so all the numbers together, right? So we got the basic. So for this scenario here, guys, on a home that's $220,000, right? You got, and we'll walk you through it one more time because I want y'all to really understand this, because even though I'm terrible at math, maybe you guys will get it when I go through it. So the house, right? The basic. So you got two things. You're burning the candle at two ends here. You got $220,000 on the purchase price. Immediately, 10% goes out the window, right? Because the home is on land, obviously. Then now you only are left with the building, which gives you $200,000. You depreciate off that 27.5 years. That leaves you with $7,272 that you can now use against your income to kind of offset it, right? Then you take that same scenario and you can almost like double dip and do cost segregation, which is a more aggressive form where you're depreciating the things in the home that are non-structural, such as a roof, electrical, windows, etc. And you guys can see the power of it. That now has brought his liability down by approximately $68,000. So you combine that $68,000 with the $7,000, and then the taxes, which we figured out would be like what, $5,000, right? So I think we worked it out to like $19K or something like that on the basic depreciation.
Yeah. So basically, you would add this to your total. Let's say all the other.
You can take that mic if you need to.
Let's say all the other expenses were like 20 grand.
Yeah,
Right? So
20
this,
grand.
This would
There
be
you go.
$27,000 deduction off your rental income. And if you had $50,000 rental income, then you got a profit.
Yeah.
Right. This one would be adding $20,000 to that. And if you had $50,000 income, it's going to produce a loss
Okay.
on that one, because
Okay.
those expenses are going to stay the same whether you do cost segregation or not.
Mhm.
So you just add up your regular expenses for all the other stuff. So if your regular expenses, like for real estate taxes, for insurance, for repairs and maintenance, for property taxes, I think I said, and mortgage interest.
Yes, mortgage. Yep.
Let's say those all add up to 20 grand.
Mhm.
We add that with the depreciation expense, that's 27,272.
Yep.
Right. But if we add 20 here, that's 88.
Bam.
Still the same rental income. One produces still a profit and you're paying tax. The other one, you're at a loss.
So just so people understand, is it better to be at a loss or profit for taxes?
Well, for tax, I mean, obviously it's better to be at a loss, but for business purposes,
Mhm.
you don't want to be losing money. You want to be making money. So, I
Right.
mean, yeah. But if you could take advantage of the tax laws and, pay less in taxes, that's the name of the game.
And this is what a lot of real estate investors do. And this is breaking it down category by category over a period of years, so you can get the best amount for depreciation, basically. So that's pretty good.
So,
yeah, so I mean,
Go ahead.
you could see basically now just you buy let's say you buy a building for 2 million.
yeah.
You can see how that is
Yeah.
pretty impactful.
How that would
or
be
let's say
crazy.
you have like in your case you got 5-6 properties you're
Yeah.
doing this on, and then you can declare yourself a real estate professional.
Bam. And can we talk about how someone would go about? So guys, just on that scenario, basically he just showed you guys how he wrote off $88,000 off of his tax returns. So now he's not liable. He was able to basically bring his liability down $80,000, which is huge.
Yeah.
And that carries
Not-
over
it's
to
not-
next year, right?
It's not the liability. It's
Sorry.
the liability. Yeah, because you at 25% in this scenario, at 25%, the difference between those two expense line items, if you're a 25% effective tax rate taxpayer, in this case would be $15,000 tax savings.
There you
That's
go.
your
Okay.
liability
That's-
saving.
yeah,
Yeah,
there you
which
go.
is huge. That's
Yeah.
huge
For someone
just
at
for one property.
150,000, yeah.
Now,
This is someone that's not a real estate professional.
right now, multiply that by 4 properties. Okay,
Crazy.
so that's 60 grand. Yeah.
And guys, you don't have to do this math yourself. Obviously, go to certified accountant that can help you with this process.
Yeah.
But just so you guys can see the background of why he does what he does.
Yeah.
Don't
Yeah.
get too caught up on the numbers that I use
Yeah.
up here because this is just very simple. Man, I'm just trying to drive the idea home. Obviously,
Yeah.
this scenario
What the
wouldn't
potential
be.
is.
Yeah, this is not going to be exact numbers.
Okay.
Yeah, but it's
And
gonna.
then
It'll be the formula is similar to this. Yeah.
okay. And then I guess so the real estate professional, sorry.
So to be qualified as a real estate professional, you have to have at least 500 hours or more in a particular year devoted to that activity. So it's called materially participating. So that's kind of the benchmark there.
What are the benefits versus just being a regular?
Well, because in this case, let's say you have a 20, in that one scenario, let's say one produces a $50,000 loss. Well, if you're not a real estate professional, you're going to only take up to $25,000 of it,
okay,
So yeah.
Versus being able to take the whole thing. So how would someone go about making themselves a real estate professional so that they can enjoy the full benefits
They
of,
just
of
got to
this?
substantiate that they have $500 or 500 hours or more in one calendar year.
Okay. And how would they be able to
Devoted.
prove it? Would be by amount of homes they own,
A
the
lot
doors?
of
Would it
yeah,
be-
I mean, in your case, you got 6 properties, and you're managing multiple properties, and you're calling repairs and maintenance and collecting rents and seeking out other investment properties too throughout the year and
Yeah.
devoting hours to that as well.
Yeah.
It's pretty easy to add up 500 hours if you have 4 or 5 properties.
Yeah, if you have multiple
Yeah.
properties, you can easily rationalize.
Usually
hey, I'm gonna-
IRS like, because it's a Schedule E, and then you've got columns for each property. So if you see, 3, 4, 5 properties, it's pretty easy to substantiate that.
Let's say
real-
someone
yeah.
can only save up to buy maybe one property in a year. How would they go about
I
making
would
themselves-
say, if they go about like maybe getting their real estate license.
Okay.
okay.
No,
that's one
a
way.
big one, because then you could substantiate that you're trying to at least work in that field. So
Mhm.
that would be another way to do it.
Okay. Maybe anything to do with like rehabbing a house or, maybe documenting when you go out. And I know a lot of people do like, what is it? Drive for dollars or something like that. Or people that basically go around and like look for homes that are like distressed or have owners that pretty much want to sell.
Oh,
or
like
whatever.
rehabs.
Yeah.
Okay.
If spending time doing that, I guess maybe they'd be
Yeah.
able to document that. Does the IRS check that heavily if you try to?
It depends,
Okay.
because if you have a really substantial loss to offset, then they might look at it a little bit more closely. Yeah.
Okay.
So you got to kind of like be a little bit realistic about it.
Okay. And because I think, the importance here is to show that like if you're a real estate professional and now you can, I think the biggest thing, and correct me if I'm wrong, Steve, here is when you're a real estate professional, let's say you own a business and you're a real estate investor, you're able to take that money that you make from your business and the money that you make from real estate that you're depreciating can also be used to offset your business earned income versus just your real estate
Right.
income.
That's when it become an issue, is when you have 2 competing types of lines of business, so they say, okay, one has to be, which one really is the materially participating. So that's really where you have to like document your activity
okay.
and your hours into that. And then there's ways to do that.
Okay.
There's certain checklists that we, go through and we substantiate that.
Yeah.
One thing I like most real estate professionals to have is their real estate license. Are we at least working towards it?
Okay.
Yeah.
That's
Yeah,
an easy
which
one.
is it's pretty easy to get. I mean,
Yeah.
it's it's not
Every
it's a little
bibbo that
tough.
comes on the show is a
Yeah.
real estate, has
Yeah,
a real estate
exactly.
agent, brother.
Especially-
That's
yeah.
like
I
part
mean,
timers, some
they
shit.
feel like 4 times already, but then they finally got it.
Yeah, they finally got
Yeah.
it. That right there will make you a professional. And I think, guys, it's worth pursuing because in my case, I'll give you guys an example. I own 7 properties, right? So I was able to kind of use the fact that I have these 7 properties to justify, hey, I am considered a real estate professional, which is worth it because when you're considered a real estate professional, now the income you can basically use it to offset even your business income from your other job.
Right.
So that's very critical, guys, because if you can only do what was it before 25%, then
Well, 25,000.
25,000.
Yeah,
okay,
right.
so
Right.
then that's
So,
not
right.
enough. You know what I'm saying?
Right.
Especially if you're making over 200,000,
Right.
whatever it may be, you're only going to be able to write off 25,000. That's not that much.
So long story short, getting the real estate, having that in your portfolio, depreciating it, versus regular versus accelerated, can give you benefits of tax, paying less in taxes, and as well for your business.
Yeah. And I would say, just a quick side note, for commercial, it's, if I'm not mistaken, it's 39 years versus over a 27 and a half year schedule.
Yes, correct.
Okay.
Yeah.
And real quick with the commercial, is it can you be a little bit more aggressive? I'm assuming since it's commercial,
Yeah, because they're
it's
more
bigger.
Yeah,
more
there's
aggressive on like something with cost segregation.
they really break, like, that's really like, most commercial properties are going to be a lot more than like a typical residential, I think, in most cases. And then that's where it would benefit you to get a engineering firm that specializes in cost segregation studies to come out and do one,
Okay.
because they will take the nuts and bolts and
Yeah.
everything.
They come out with a tape
Yeah.
measure and
I
they
mean,
actually
they get, so because you're spending a couple $1,000s, it's well worth it because the tax savings in this. Let's say you spent $3,000 on a cost segregation study. I mean,
Mhm.
you're saving 15 grand in this scenario. That would definitely be worth it.
Yeah. So you can only imagine
And if
doing
you
it
got
on a commercial
multiple,
property
right,
worth a couple million. Now we're talking you spent $5,000 to bring, some guy out with a protractor figuring out which you're gonna, could write off, but that could potentially save you hundreds of thousands.
Right. And
and I'm sure they give you documentation you can use to give to the IRS.
Everything. It's
So
it's bulletproof.
IRS try to
bulletproof.
say, hey,
Yeah.
we want to audit. Oh, okay.
Yeah.
You actually
You triggered my trap card.
I got the fucking,
I'll tell you a quick story. I worked with early on. I worked with a partner, a CPA. He was a partner in a firm. His wife was a PhD. Actually, got a job with the Internal Revenue Service, and her job specifically was to do an analysis on depreciation. So that's why this cost segregation stuff is. And they paid her $200,000 a year, and all she did was basically study depreciation methods, and on all, like, it was like she worked there for a few years. Huge amount of money that they invested. This would have been back in 2013 or something like that.
And as a former government employee, guys, no one really earns $200,000 per year unless like you're in Congress and stuff.
Yeah.
You know what I'm saying? That's extremely high for a government employee.
They shipped her out to Washington, D.C., and she spent like literally like working on this stuff. So the people that work in this cost segregation industry, they adhere to, like, they came out with all of this, basically all the rules of all the depreciation and all the component pieces, everything's on so those cost segregation study firms, they adhere strictly to those
regulations.
The regulations of the IRS there.
Damn.
Yeah.
Okay, bulletproof, man, bulletproof. So you guys can see, obviously, when you're buying like bigger properties or whatever, it's worth it to hire someone. On my scenario, we were able to just do it, regularly.
Yeah, you
basic.
did. And yours, it's a mini cost segregation study. You don't need to hire somebody to do it.
Yeah.
You just kind of do it.
Yeah. So we did it very, like, as you guys know, I talked about this before. I bought a property. I actually closed on a property, $265,000. Right. I bought it cash, because I needed to get it done before the tax year ended, and I didn't have time to get a loan. So bought it cash, $265,000. And the reason why I did it was because it was recently rehabbed. It was a turnkey property, and turnkey, guys, means it's basically ready to go once you purchase it. So I bought it. As soon as I bought it, I called Steve. Hey guys, hey Steve, I purchased it. This is, the address, etc. This is how much it's worth. And what Steve was able to do is he was able to use, the depreciation, which he just showed you right there with the example at the 27.5-year scale. And then we're also able to do the cost segregation as well. And that was able to knock off a bit more as far as like, what I would be, I guess, liable for.
Right.
So that's the importance of it, guys. Why it's like, it's so deadly. You know, I'm not deadly, but it's so important when it comes to, you know, helping you out with your taxes. Then we also made myself a real estate professional, so I was able to deduct the full amount over $25,000. And all I'm gonna say is I would have had probably double the tax bill had I not purchased those real estate properties this year.
Right. And in your case, on those properties, a lot of those were like improved.
Yeah.
So a lot of those improvements to those properties have better depreciation amounts
Yes.
to take. That's the key there on those.
Yeah.
So I think
you know what?
we talked about that.
Thank you for mentioning that. Yeah.
That was a big one because I think you went back to the previous guys and they could really
Yes, so
they
let
had
me-
all of it documented.
So this is what I did, guys. All right, I'm give you all a little bit of secret sauce here. I purchased the houses, right? Basically turnkey, and they were all recently rehabbed. So what I did was I contacted every seller I purchased the home from, and I asked them, listen, roughly how much did you spend on fixing the home? You know, and they have no point to lie to me at this point because it's like I already own the house. It is what it is. And they gave me rough estimates. We basically rounded down,
Right.
and we were able to use those rehab costs of what they spent their money on to go ahead and offset my taxes. Okay, does that make sense? And then on top of that, remember, guys, when you purchase the home, let's say you get a loan and you only put $100,000 into the home is worth, you know, $400,000. So you only put 25% down. Guess what? You could depreciate at the $400,000 price point, not what you necessarily put into it. You guys understand that? I'm gonna say that one more time for y'all because that's really powerful. You buy the house for $400,000. You only put $100,000 of your own money into the deal. However, you could depreciate the entire cost amount of $400,000, from which you only put 25% of your own money, and the other 75% came from the bank. So, in other words, you're using other people's money to offset your own taxes so that you pay less. And this stuff like this, guys, is why the rich and the wealthy stay rich and fucking wealthy. This is the glitch in the matrix, guys, because the U.S. government, what I've come to realize is if you own real estate or you own a business and you're providing housing and employment to people, the U.S. government rewards that heavily and incentivizes them to give you big tax breaks because people that provide housing and jobs keep the economy going. So that's why you get such a big tax break on these types of things. Go ahead.
Nursing homes, very good business because once again, you can use those principles regarding taxes and you're employing people, same time housing people as well. So there you go.
Yeah, I know a lot of people that they start like assisted living facilities.
Yep, those.
With like small rental home. Yeah, so we used to go to a lot of those properties actually and take X-rays.
Yeah, a lot of guys I know that have money here in Florida. That's what they do.
Yeah,
yeah,
it's a big business. Yeah,
there you go.
especially here in Florida.
No facts. So we have some super chats here, Chris. I believe if you want to bring them up, if you don't mind. All right, Highlander 2016, $2 says, "Is it the same tax laws for the U.S. Virgin Islands?" Ooh,
That I don't know. I mean, I know it's a Commonwealth. I don't know if there's a tax act with them. To be honest with you, because I haven't dealt with that. So.
I don't hear anyone going there either myself. Just Puerto Rico.
No, I'd never heard anything like as a tax haven.
Yeah.
you know, it's different because it's a different treaty with U.S. Virgin Islands.
Yeah, I'm
than
not
it
too
is
sure
with Puerto
about
Rico.
that either. Orlando Beer Sing $5 says, on the topic of moving to Puerto Rico for tax benefits, does that work for the Virgin Islands? Would it be the
Kind
same?
of the same
Kinda same
question. Yeah.
Yeah, we're not sure about that, brother. We got here Desmond Montgomery, $5 says, I stopped being independent for 4 months in 2021. I worked 2 jobs in my own business. Is there a way I can still get a tax return or avoiding paying taxes? So she said she worked 2 jobs in her own business and she's stopped being independent for 4 months in 2021. Can she get a return or avoid paying taxes?
I guess you're gonna have to ask your whoever was, if it's your mom or your dad, whoever was taking you on their taxes, if they could not take you for 2021, then you could declare yourself independent, file your own return, and then declare yourself on your own return as an independent. Yeah, you could definitely do that.
Okay.
And then I'm sure, I don't know how much you made, so I mean, it all depends on how much you made. So on the avoid paying taxes question, that's depends on how much you made.
All right. And we have King Kareem, $5 says, I drive for Uber. Is it better? And I'll definitely make over 50K this year. Should I create an LLC for my Uber? Also, can I deduct my car payments,
Oh,
etc.?
that's a really good question with LLCs versus S corps.
Yeah.
You wanna knock
and
this one out the
that
park?
was the last
Go
one we
ahead.
talked about. Yeah,
Go
so
ahead.
at $50,000, I don't know what your expenses are going to be, but let's say your expenses are 20 and you got a $30,000 profit. And you're going to have to pay self-employment tax if you file it on your personal income tax return of 15.3%. and then you're going to have to pay regular ordinary income tax return tax. So you might want to consider becoming you could still do an LLC, but convert it to be treated as a corporation, and more specifically an S corporation, and then you can avoid some of those self-employment taxes altogether. You don't want to avoid 100% of them, so you want to put something in there where you have to pay the self-employment tax on it, maybe 10,000 of the $30,000 profit, and then bring the $20,000 over and pay ordinary income tax, and that's going to save you a few $1,000s on there. So yeah, definitely it makes sense for you, but you want to make that LLC, turn it into an S corporation.
And they have a finite amount of time to do it, right? If I'm not mistaken.
Yeah,
It's
you
gotta
want to
be
do it within the
first.
first. Yeah. So if you file it, you're supposed to do it within so many days after you file, inform the corporation, and you get your tax ID number. But as long as you do it with it, because a lot of times I do it and I file those forms along with filing their first income tax return, and then the IRS will, in most cases, will accept it.
Okay.
as
Is it
a
within
late
a year
filing.
or 2 years? I remember
Within
we
a
did it
year.
for me.
Within a year. Yeah,
Okay.
within a year, you want to do it. Yeah.
Yeah, because I remember when I had my joint, it was LLC, and I remember you told me, hey,
Yeah,
we got to
we
switch
did.
you over to S corp
Yeah.
because you're pretty much
You were going to get
one person.
killed. Yeah. You were
Yeah,
gonna get killed on the
Because then I
tax
had
side,
my
yeah.
government job too. So for you guys that have
Right.
a side hustle and you have a W-2 job and you're also trying to get on your entrepreneur grind, forgive me if I'm dumbing it down, but essentially you're taxing yourself twice when you
Right.
do that
Right.
LLC versus and
Right.
having a W-2 income, right?
Exactly.
Okay.
Because they always say get LLC, but they don't tell you
Oh,
the tax
there's
things.
another one too. We'll keep doing the super chats, but don't let me forget to talk about the 1099K.
Okay.
Oh,
All right. let
Did
me
we
write
talk about
down.
that earlier? Did I talk to you about
We
that?
mentioned no. Me and him were talking about it before you got here.
Yeah.
But we can definitely talk
That's
about it.
coming
for the
next
people.
year.
Okay.
So this year, right now, it's happening. And we'll talk
You know what?
about
Fuck it.
this.
Let's talk. We could talk about it now.
Okay, so
Let's break it down to 1099K because I don't even know what this is. So
okay, so like for instance, like you get Zelle, you get Cash App, you
Yep.
get Venmo,
Yep.
etc.
Mhm.
Okay, so if you have a business and you're getting those forms of payment,
Mhm.
those payment providers or processors had to give you a 1099
okay.
every year. And the way they did it, the benchmark was if you got paid over 20,000 and you had more than 200 transactions in 1 year.
Mm,
If you had 20,000 and you only had 100 transactions, no 1099K, right? So they had to have both of those requirements, 20,000 and 200 transactions, you get a 1099K.
okay.
That gets reported to the Internal Revenue Service.
Okay.
They have it in your transcript. So then you have to file that and you have to report that income.
Okay.
Well, you know what they did with the Affordable Care Act? They stuck it in there
AK Obamacare,
with all
right?
this stimulus money.
Oh, that's the Obamacare
Or, no, the latest one. I misspoke. The one that they just passed
on the
with
Trump
with
administration.
yeah,
or
with the
under Biden?
stimulus. No, the stimulus package.
Oh, okay.
one,
Okay.
the new-
Okay.
Yeah,
Okay. Go
they
ahead.
snuck it in there. Now, what they're doing is, if you have a business account and you're collecting any type of, Zelle or Cash App or Venmo or anything like that, if it's over $600 and it's one transaction, you're going to get a 1099K. So let's say you have a garage sale or something, or you sell a couple of items and you got $1,200. Somebody's like, "Hey, you got Cash App?" And you're going to have to report that because that gets reported to the Internal Revenue Service.
Mm.
And
Big
that,
difference.
that's interesting because there's been probably a surge in payments being done through Cash App, Zelle, or these because of the pandemic. Essentially, a lot of people started digital businesses. A lot of people started using these type of payment
That's
processors.
the
to
yeah,
accept
we're in
payments.
the gig economy, so
Yeah.
everybody's working from home remotely, and you got your websites over there.
Yeah.
That's, a lot of your
Yeah.
guests there.
They're selling feet pictures that you
They're-
chicks are getting caught now.
Literally.
All right, y'all getting them Cash Apps. The
PayPal?
IRS is coming. God damn it!
PayPal too.
You know what I'm saying?
There's
PayPal
a
too.
rumor, right?
PayPal too. Yes.
There's a rumor about if you put an emoji as the description, for some reason it wouldn't register as like a transaction. I don't know if that's
maybe
true or
that's a
not,
hack. We're gonna have to
but
try that.
I was
one.
like, what?
Maybe
they
test it.
They said-
Test it.
they
Yeah.
said stop typing
Keep good records.
a description. Just put an emoji. I don't know if that help or not. But hey.
Interesting. I don't know. Who knows? Because they haven't produced them yet, though.
Uh,
Can you imagine
they haven't
somebody's
produced
like,
them yet?
"Oh yeah, I'm just gonna put emojis on all my shit. I'll be good, bro. I ain't never gonna get in trouble." Next thing you know,
FBI, open up!
you know what I'm saying?
Exactly.
I thought that was hilarious.
Yeah, I don't
Get
know about
dragged
that.
away in cuffs and shit.
Where'd you hear that from?
it was some meme going around. I don't know,
Really?
man. Some
Okay,
random thing
yeah.
on social media.
Sounds like shit.
So
Okay, let's hit some of these chats. And guys, do me a quick favor, man. We didn't want to stop the show for likes. Do me a favor and like the goddamn video because we just gave y'all
gems.
a whole
Hacks.
clinic on depreciation versus cost segregation, aka a more accelerated form of depreciation, and showing you guys the secret sauce. This is how the wealthy stay wealthy, guys. This is how Robert Kiyosaki, Grant Cardone, etc. They basically are able to use depreciation along with accelerated depreciation to bring their earned income to almost goddamn zero, and that's how they don't pay taxes. You know, some of these guys are probably paying less taxes than their own employees that make $50K a year. You know what I'm saying? It's ridiculous. You know, maybe would you fair? I don't know.
Yeah.
Yeah. That's
Oh,
what
yeah.
they're doing.
Yeah.
You know? Okay, $10, Mr. Onizuka. And it's all 100% legal, by the way, guys. It's all 100% legal. I need some help figuring out what my 18-year-old daughter should invest into. She currently has AK and she has put $2,500 into ETH.
ETH. Is that
ETH.
Ethereum?
Yeah, Ethereum, yeah.
Buy more. It's down. It's low.
There
It's
you
like
go. It's low right now.
buy the dip.
Yeah.
Put her all underneath right now. Yeah, because that's a safe coin to you know, it's more of a blue chip coin. So I would definitely, you know, without getting into the other alternative stuff.
Yeah.
Yeah. I think you got a lot of
Yeah, I got a lot of
yeah.
Ethereum. Like,
It's down now, but it's
Charlie and
yeah.
Miguel for that tip.
yeah.
Shout out to
Charlie
them.
Miguel
Yeah.
were telling us, you know, shout out to our crypto guys. I was actually on the phone with Charlie a couple of days ago. When in doubt, guys, buy Ethereum. That's literally what they say. When in
Yeah.
doubt, just buy Ethereum. You know what I'm saying? The problem with Bitcoin is that it's a little too high to get into now. I mean, right now it's on a dip. It's last time I checked, it was around 35K.
35. Yeah.
Let me see what it's at right now. But
I think ETH was like in 2000 something.
yeah,
It's like in
so
2000.
let's see here at the market right now. So as of this very moment, okay, 9:57 p.m. on Monday, 36,313 is what Bitcoin is at, and Ethereum's at about 2,400.
Yeah,
so-
buy more.
Yeah. So
Maybe
yeah, man, buying a dip, guys. Buying a dip because it's gonna go back up. Manny, any accountant Steve knows personally in NYC or Northern New Jersey he could recommend me to work with?
No, unfortunately.
Okay.
Yeah, I don't have any contacts there.
But you do New York as well, right? Or
I do, yeah, but
because
a
you're
lot
from New York
less now.
originally.
I'm originally from New York. Yeah.
Yeah.
Yeah. So yeah, I don't not too much. Anymore.
Okay.
Yeah.
Okay.
With $5 from Pos Nation, with a death involved, will there be a tax event upon withdrawal from an inherited IRA BDA transferred from a 401 account, 401k account with no job or income? Oh shit!
It's very specific.
With a death involved.
Can you highlight it, Chris?
Will there be
If that's
a
involved,
tax event upon withdrawal from a inherited?
IRA.
Yeah, I could read it one more time. With the death involved, will there be a tax event upon withdrawal from an inherited IRA BDA transferred from a 401k account with no job or income? So what it sounds like to me is you're basically taking money from someone that deceased 401k. Is that a taxable event?
I mean, I don't know what the dollar amount is. I'm assuming it's a substantial. If they give tax it, it could be under what $16,000, I think it is. But I believe
Need more
if it's coming
details?
from, you know, because the 401k, anytime you have a withdrawal, whoever is the custodian of that account has to fill out specific forms with the IRS and report it.
Yeah.
There's no way around it.
Mhm.
So depending on how they code that, if it's going to be coded as a rollover or a full like cash out,
Mhm.
I'm assuming it's probably going to be a taxable event.
Yeah,
Okay.
it probably
Yeah.
will be no matter what.
Yeah. I mean,
It's not like it's your own.
Yeah.
you're
you
not
would need
taking it
more
from-
details too. To
You're not
conclusively know, right?
recharacterizing your own retirement account into another, tax sheltered account.
Yeah.
So it's from someone else. So I'm assuming that it's probably going to be a taxable event. And yeah.
Okay. All right. And Pos Nation, if you have any other facts that you want to throw to it real quick, feel free to do it. Sebastian, $5 because that's a very particular question. $5. What about purchasing rental units and storing Bitcoin miners inside of the units instead of people?
Is that still very profitable?
that's a good
Bitcoin
one.
mining?
I mean, Charlie was saying no.
Yeah, I don't think that is
It's
as
a,
good as
it's
it
a
used to
dying
be back in the
industry.
day.
Yeah.
That's a good one.
that's pretty funny, though.
Jab Crow host Joe, would you ever have Nomad Capitalists on someday? I don't know who he
Don't
is,
know
but we
who
can
it
look him
is.
up. Exploit, how much money $10? How much money do you need to save up to get a duplex with an FHA loan?
3%. Is it? Was it 3%?
3.5%.
3.5.
3.5. Right.
Yeah.
Okay.
Fresh actually did it. You want to tell them real quick about how you got give them
Yeah.
the cliffs on your joint?
So I got a property 2 years ago. It was 330K. I put 12K down, which is like 3% of the property.
Triplex guys.
And my first one, working a regular job, $15 an hour. So it's doable. You need to get approved. You need to live in that unit for like at least a year. So you can do it 100%.
Yeah.
So-
It's basically a way to get into a property and control it The only caveat is you got to live in it for a year.
Yeah.
And there's also grants, and there's also special programs where you can actually get loans for home improvements on your taxes. So like you can get up to 20 to 40K. You can put in windows, ACs, all that stuff in your units
Okay.
without actually having the money.
Oh shit.
Yeah,
Okay.
there's
Well,
grants
what's
for
the
that.
name of it? Because since you remember.
There's companies like Y Green. Another one I think is Elance. Basically, you sign with a company. They go over your taxes, they go over your property, how much it's worth, how much you owe on it, and then they'll give you a loan for you to improve the property.
Okay. Do you have to make under a certain amount to be able to qualify, or it doesn't matter?
I don't know. Probably because it'd be
Is it-
unfair if you didn't.
Is it related to like an economic development zone? Maybe because it's in a certain area.
I think that's a
And
caveat
they're
as well.
trying to like gentrify it. the
Yeah, because
area,
in
so-
my area, that's what they're trying to do. Exactly.
Okay.
Okay. All right. So, and then we got here $10. Baba Tunde. Hey guys, I always watch the Money Mondays. Thanks for what you guys praying for your continued success. Hey, FNF God bless y'all's. Always. Any recommendations for first time independent filers?
Any recommendations? Well, I think it was those three that we covered right in the beginning.
Yes.
Those
the
would
new
be the
Biden
three. If you go
administration.
back, I don't know if you were joining us late, but those would be the three major ones that
At the
you
top of the
probably
show,
wanna pay
guys, check that
attention
out.
to. So make sure, like, do you qualify for the because probably somebody claimed you prior, so they
Mhm.
might have already gotten the payment on your behalf. But if nobody claimed you last year, then you might be entitled to that $1,400
Mhm.
amount. As an independent filer, I don't know if you have dependents or kids or whatever, so then maybe that's not an issue.
And for some of you guys that are wondering, when he's referring to claiming someone, it's like if your parents can claim you as a dependent and
Yeah.
then they get a tax break because they support you. So
Right.
if you're independent for the first time, that means your parents didn't claim you on their taxes, and now you can actually, you can do it yourself versus them claiming you and you can't.
Correct. Yeah.
Okay. And then we got $5. Larry, I understand there's ways to save money with taxes, but is there anything we can do that we can get for free, like with Section 179?
I mean, Section 179 is you get a full expense deduction instead of like putting it like we did over here on the board where we're allocating things over years,
Mhm.
right?
Yeah.
Where you get to expense the full amount.
Yeah.
In year one.
Okay.
Example, your car that you guys bought that we did the show on.
Oh,
Remember I did the show on? We had the
yes.
real bad connection.
Should we break that down real fast?
Yeah.
Because someone else asked about the G-Wagon anyway, so that falls right into
Well, the
it. So-
G-Wagon, because it's a heavy car, it's over 6,000 pounds. It's the same thing. You guys, you can do, and it's got to have a legitimate business purpose.
Right.
Okay.
Okay. And then it's always better if you're going to deduct the whole thing that you have a second vehicle on hand
Mhm.
for personal use. Then you can substantiate that you use that car 100% for business.
Okay.
But if you don't substantiate, if you don't have a second car, then obviously you're using a car for personal use. So you don't want to write 100% of it off.
Okay.
You want to take like maybe 75, 80%
Okay.
because 20% or 25% you're using that for personal.
Okay.
You know.
So having another car will
But
allow
if
you.
have another one because they ask you that question, like, do you have
Mm.
another car available? Because you don't.
That's a
if-
gem right there,
yeah,
Steve. Right there.
Yeah,
just
a
knowing
lot of
that.
guys. Oh, I'm 100% of it's all business. Come on, you go to Publix, you go out, to the gym, you go. You're using a portion of that percentage of that usage you're using for personal. So
So
you got to be reasonable. That's a
Um,
red flag.
I guess real quick, can we give a scenario? Maybe let's say you buy $100,000 vehicle, a Range Rover, a G-Wagon, whatever it is, one of these vehicles that
Yeah,
qualifies
so-
under this provision.
Yeah.
What are they looking for from a numerical standpoint? I don't know if you want to do it on the board or you prefer to just do
Well,
it.
it's very simple. It's certain cars qualify for Section 179. They're very
Mhm.
specific. A G-Wagon being one of them because
Mhm.
it's heavy. It's a heavy vehicle. It's over 6,000 pounds.
Okay.
So let's say you pay $100,000 for it.
Mhm.
You use it for 80% business.
Okay.
You get an $80,000 write-off.
Bam.
Boom.
That first year.
That first year.
And you can choose to take it all up front, or should you do it, or can you also take it up over time? Like we
You
talked about
could,
here?
yeah. Sometimes I stagger it because sometimes you don't need that huge deduction. And
Okay.
It creates too much of a loss, and they might be expecting more income later.
Okay.
That we could use more of that expense later on. So sometimes I don't do that, or I'll forego some of the bonus depreciation
Okay.
as well. So you could play around with it because you could be more conservative because you're expecting to make more money
Yep.
in future years, and you're going to need more expense. So
Okay.
you may not want to take it all up front.
There you go. And
Question,
then
you can only buy one car a year with that benefit, right? Or can you buy multiple cars for that benefit?
No, there's no limit on it. Yeah.
So I could buy
Yes.
4 Range Rovers.
Yeah. And you
80,
can take
80K each.
Yeah, I've had clients that they have construction businesses. They buy trucks every year for the right at the end of the year. Like, where am
Sheesh.
I at? And they'll spend all that money and get a huge rent because they need to replace their equipment on a more frequent basis. And they'll right in
Oh.
December they'll go and make deals. And
I used to wonder why.
I
people-
just learned something just now, bro.
Yeah.
Yeah, I used to wonder why all these people like Grant Cardone will buy Rolls Royce
right at the end of the year.
and
Right
buy
at the end of the year.
G-Wagons.
Yeah.
I'm like, you bought 3 back to back. God damn. But
Yeah.
it's right
they're
off.
right at the end of the year.
So that he can. Oh wow! And then you can actually choose to take it up front. And then and I think that this is very important that I would just thought about as Steve was saying that. Remember, guys, that when you're getting a loan to try to buy a home or whatever it is, they're going to look at your profit loss statements. They're going to look at how much money you actually netted. So when you do crazy deductions like that, what you're doing is you're basically saying, "Hey, I made less money, guys," and that will hurt you as far as getting a loan. So it's
That's
very
a
important
good-
to strategize these
That's
things.
a good point. However, depreciation is called an add back. So whenever the loan officer sits down or the underwriter that's giving you the mortgage
Okay.
on there, they add back depreciation and they don't count that against you as an expense because it's a non yeah.
I did not
That's
know
an
that.
add back. So that's even a better benefit.
Okay,
that, yeah.
so that's right there, an unintended
Yeah.
benefit right there. So you can actually, so quick scenario, you buy a Range, it's like it's the end of the year, you need to find a way to offset your taxes. You buy a Range Rover over 6,000 pounds.
Right.
It's $100,000 for
And
easy purposes.
Let's say it puts you in a loss hypothetically.
Yeah.
But the bank, when they look at it, they add that back.
They add that 80K back that you wrote off.
Yes. So it looks more profitable for lending purposes.
Okay,
Yeah.
that's good. That's good because I know a lot of people are like scared sometimes to write too many things off because it makes their I
Yeah.
guess earned income go
Yeah,
down, which
but-
the banks look like, yo, you didn't make no money this year, bro.
Right.
The
But
hell?
depreciation is not one that you need to worry about.
Okay,
Okay.
perfect, perfect.
Well,
So I think
called
that's
a-
important
yeah.
for the people to know that you cannot write off the most things and then also at the same time get loans easily. It's very
Because it goes
difficult
back to the
coexist.
scenario that you talked about, buying a $400,000 property and only putting 100 down, right? And you're still taking a big depreciation deduction.
Yeah, at the,
That's
at the purchase price.
non-cash. So it's not because the bank's more worried about your cash flow for debt service, right? They want 40% debt to income service, right?
Mhm.
So they want to make sure so that's a non-cash item, right? In that
Mhm.
scenario, because you're putting $100,000 down and you're taking, let's say, a $50,000 depreciation deduction.
versus
That's
80,000.
non-cash,
Okay.
right? So that doesn't affect your cash flow. So that's
Damn.
what they're trying to derive more of the cash flow to make sure that you have enough money to pay your debt service. on a
And can
monthly
you
basis.
tell the people real quick income to debt ratio, break it down for the people because this is
I mean,
something that
typically,
a lot
I
of
think that the gold standard is like you were finding it was 40%, right? Wasn't
Yeah.
it 40% when you were doing your loans? Basically, that your debt service and all your your expenses, that you want to make sure that it does not exceed 40% of your total income on a monthly basis, in order for you to have the ability to pay that loan back.
Mhm.
Otherwise, you get into a risk with that bank, and they're not gonna, they're
You're
probably
considered a high risk
they'll pass on it,
borrower.
yeah.
Okay.
Or raise your interest. They try to get you on that. That's a healthy cash flow.
Okay.
40%.
40, 60. And you want to
40,
be
yeah.
the lower that 70-30 is
They call
better.
it, 40% debt to income ratio.
Okay.
Okay. So the lower on that other side, guys, the better, the
Better.
more likely
Yeah.
you're going to get approved
Yeah.
for loans. So just know that, especially for home loans to get a mortgage. Where we at?
What?
Yo, we can drop a lot of gems, guys. Like
For
the
real.
goddamn video, man. Steve's putting on a clinic out here.
And this is free
The free stuff,
for
man.
y'all, man.
Uh,
Reginald Deborah, $5 says, what should I use instead of Cash App or Zelle or PayPal? And what's the best payroll company to use for someone in Minnesota?
What should you use besides that? I mean, they've got Venmo, PayPal. I don't know.
Yeah,
You guys got any ideas on that one?
I guess just Venmo.
Bitcoin.
is
Um,
what Cash App, Zelle, or payment with the best payout company to use? Oh, okay. Go ahead, Bianca. Yo, can we throw her on real quick? She's on
Go
mic.
ahead.
Okay, go ahead, Bianca.
What would you recommend?
You got son? Out of
Hi.
nowhere.
Yeah, I know. Just really quick, I think that there's a lot of people that are confused when it comes down to Venmo and Cash App. It's only when the account is a business account.
Yes, it's
Not
got to
a
be a business,
personal
not
account.
personal social
So if
security
people
number.
are sending you money and it's not a business
No, no,
account,
no, no.
you don't have to do
Correct.
taxes on it.
Correct.
Oh,
That's a good clarification. Yes, because actually I was talking to
Of course,
someone
the girl knows.
at the
Shout out to
restaurant.
Bianca.
Yeah,
She was selling
yeah.
the feet pics. God damn
The
it.
OnlyFans sounds
Yeah,
Go ahead.
that's a good one. Yeah, very good. Yes, so let's differentiate. If it's a business account, you're accepting. Like in your case, you got a business account that's going in there. Yeah, that's when you got to pay attention to that.
Yeah.
Shout out to Bianca in the
Just
back.
because I do
Good job.
like a lot of business through there,
Yeah.
and I don't have to pay taxes because I'm not a business. I'm still my personal account.
Correct.
Okay.
Yeah.
But is there a certain amount though, Steve, where like if you're making a certain amount, they're like, bro, it don't matter if it's personal, you got to report this now.
No, I don't think they're going to go and just, put the burden of doing that on all of the personal taxpayers.
Okay.
Personal Social Security numbers. That's a big burden for them.
Yeah.
Just
it
even in the
is.
businesses alone.
You're
it's a huge
chasing after
burden, yeah.
quarters when you should be going after dollars,
Yeah.
essentially, right?
It is the same thing for businesses too. Like if you pay an independent contractor, anybody working for you here over $600, you have to give them a 1099 by law.
Mm.
So it's kind of the same thing. you know,
Okay.
even though you're paying them, because you as the business
Uh-huh.
owner want to substantiate that you paid them and you want to take that deduction.
Yeah.
On your
Okay.
return. Yeah.
Fair enough. Maximum Duke, if you comment or flag the payment on Zelle, etc., as a birthday gift, will it still get reported?
I mean,
Again, it's just going to be, if it's a business account, it doesn't matter. If it's over $600 starting this year, they're gonna
Crack down.
you're
on
gonna
it.
get a 1099K.
Yeah. What I've noticed is, as the COVID restrictions have been going down, they've been far more aggressive with pursuing you now for tax
Well, because they gave
reasons.
all that money out and now
Yeah.
they want some of it
They want
back.
to get it back.
And they're gonna,
Trying to recoup.
it's a way for them to
yeah.
keep people honest
They're-
now, and with compliance by force. You know what I mean?
They're getting it back in blood.
So they're getting it
They
back.
gave it to you. Now they're getting
Yeah.
it back in blood. Okay, let's see here. We got $10 Maze Jackson for business owners who can't afford an accountant. How do you recommend we keep our books, receipts, spreadsheet, app, etc.? My other super chat about business bank accounts didn't get read.
Basically, if you're using a bank account, all of that stuff, like we talked about, is all downloadable into an Excel spreadsheet, and you can sort it.
Okay.
Yeah.
$10 Chris Loya. You can send a Zelle payment, Zelle, PayPal, or Cash App. You put in the memo, happy birthday or split check. It cannot be taxed. Don't know how true it is, but something I heard.
Yeah, I heard about that and then emojis. I'm like, I don't know about that, bro. But hey,
What's your take on that, Steve?
Wait, which one are you reading right now? The
Chris
date-
Lawyer.
the-
10.
Oh, the one down. Okay. It says, can you send PayPal, Cash App, and happy birthday or split check to be traveled? Don't know. I don't know.
That's a unique situation.
Yeah. I wouldn't advise to do that.
They're gonna say happy
unless it's
birthday.
legitimate.
Split check.
Yeah.
Wait, how many birthdays people do you know? I actually know. Like they gonna know, bro. Like
Yeah. To me, I look at it like
It's
you
not
do
worth
that too
it, yeah.
often.
It's not worth it.
You gotta get
what do you
audited,
think?
bro.
Yeah.
birthday check. Birthday check.
Yeah, they're gonna be like,
Yeah.
"Oh, okay,
Wait a minute.
it's a birthday every day, bro." The government's gonna be like, "Listen, bro, we
Happy birthday
Yeah.
to ya.
like we ain't stupid." They're gonna be like, "You think we're
Stupid.
Next thing you know,
Keep my money.
A year later,
Yeah.
Chances
Chances are you're not going to get caught doing that. But let's say you're the one in a million that does, and then for
Fucking
saving
blows.
$1,000, and then 3 years later, now that bill turns into $4,000. Like, was
Yeah.
it worth it?
Listen, man,
Yeah,
if you haven't
audited.
learned by now, look what's
Wasn't
this
worth
next.
it,
Pay your
yeah.
taxes, nigga.
yeah, pay your taxes, bro.
All
I day trade stocks, so all positions closed. My account was up 500% in 2021. Is there any way of reducing capital gains tax?
You could put it in a retirement account. That's looking like a self-directed 401k, which we were going to talk about. We'll have to do a show on that.